the India investment story and the economic story has been hard to miss the past few years. But I'm sure our perception of that story is just filled with misconceptions. So what are some of the most common misconceptions you hear from Western investors when it comes to India? And how should we be thinking about India?
Sure. So look, when I go to the United States and to the UK to pitch to institutional investors, right? The three things which perplex me a little bit. They perplex me less now than they did 5 years ago, but even now I get sometimes thrown aback. The first is there's this perception that India is a poor country. And so some people call it poor, some people call it underdeveloped. That's wrong. It's an incredibly this is an incredibly wealthy country. Our estimate is household wealth in India is around $10 trillion. Now, clearly, that is unevenly distributed, right? It's unevenly distributed. We are one of the least equal societies in the world. But because there are 1.5 billion people in this country, you have roughly 100 million people operating at close to first world levels of wealth and income. And that gives this country an enormous impetus, whether it's in consumption or indeed in stock market investing. So if I look at the data, right, last 5 years, every year, roughly $100 billion of financial assets has come into the Indian financial system from local households, right? And this is households buying life insurance, general insurance, mutual funds, direct stock market investing, and so on. So I think the first piece to realize is this is a country with a very high savings rate, and it's had a high savings rate for nearly 20, 25 years. So the pot of wealth in this country is very large. And I think for Australian audiences who watch the IPL, I think it won't be hard for them to understand this, right? Because you can see the world's highest paid cricketers play in India. And one of the reasons for that is the people watching the IPL are people with spending power, which is why the advertising revenues coming from the IPL are so big. So that's the first point to sort of clock that this is actually quite a wealthy country. In fact, if you look at the Indian stock market, other than the United States, other than the American market, no other market in the world has made so much money in the last 10 years. The Indian stock market has grown by $2 trillion. It was worth a trillion and a half a decade ago. It's worth $3.5 trillion today. That's also a measure of just how much wealth has been created in India, $2 trillion of stock market wealth. I think the second misconception is that somehow this is a wild west. This is a ropey country with dodgy courts and dodgy rules and regs. And I'm not claiming it's a perfect setup. I don't think any democracy, any free market democracy, can claim to be perfect. That's the sort of nature of free market democracies. You will have your ups and downs, but by and large, the local legal and regulatory system works. I played my little role in sitting in several regulatory committees, but by and large, compared to say markets like China or indeed the United States, this is actually a fairly robust regulatory system with courts which are by and large fair. So whether it's an institutional investor coming in to invest in the Indian stock market, it's a retail investor in Australia, or an Australian company making investments on the ground in India, you will get a pretty fair shake. You'll get a fair shake from what is a relatively transparent and well-managed regulatory and legal system. And the third piece that I get a little perplexed by is this point of view on valuations, right? This is, if you ask me, this is the biggest bugbear I have with Western investors. A lot of people expect to see a developing nation to have cheap valuations. But if that developing nation has been growing at 7% real for 20 years, and if well-managed companies are growing their cash flows at 25% for 20 years, you're not going to get them at 20, 30 PE, right? You'll have to pay up for that. And therefore the kind of quaint notion that I'm entering a developing economy, give me developing economy valuations, it doesn't work. And those who sort of, the foreign investors who keep waiting for India to get cheap, I suspect they'll be waiting for many more years for India to get cheap.
Well, I mean, with those misconceptions in mind, how should we be thinking about investing in India? Like, you've made it now sound like a pretty tantalizing opportunity. So how should we in the Equity Mates community start to think about investing in India?
So I think from a practical perspective, I don't think foreign nationals can individually come in. I don't think it's easy for foreign nationals to individually come in. What foreign nationals can do is invest in India funds. So there's a whole host of global fund management houses, the Fidelities and Capitals, who will have India funds, I'm sure. There's a bunch of American ETFs as well. So, for example, I think MSCI, not MSCI, sorry, BlackRock. BlackRock runs the largest Indian ETF. The iShares line of products has a India ETF available, which is the largest ETF coming into India. But the other thing that the Indian government has made relatively easy is it's allowed pension funds or mutual funds or indeed even foreign corporates to come and invest in the Indian market. That whole process of a foreign corporate or a foreign fund or a foreign endowment or family office based in Sydney coming and investing in the Indian market has been made quite straightforward. You basically register with your custodian. Your custodian could be Citigroup or Bank of New York Mellon or Deutsche Bank. You choose your custodian. The custodian sets you up to invest in India, and that's the legal piece done and dusted. Now, in terms of stock selection, I could recommend my books if you want to sort of get a primer on how to select stocks in India. Diamonds in the Dust is the book my colleagues and I've written. That too has been pirated widely, and it's been translated into various Indian languages. The first part of Diamonds in the Dust focuses on accounting fraud and how you can detect which Indian companies are cooking their books. That's roughly 40% of Indian companies you eliminate through the forensic accounting route. And then the second piece of the book is on a capital allocation. Because this is a country with high growth, you need to look for rational capital allocators, companies who can deliver a return on capital consistently of 15% or better. And the final piece is dominant franchises, right? Much like America between 1880 to 1930, we're going through a bit of a gold rush or land rush ourselves. So smart companies who are conquering entire industries are doing so quietly. You don't want to go on sort of TV or CNBC and shout out from the rooftops that you're grabbing the commanding heights of the Indian economy. So you and I have to do a little bit of work to figure out who are these companies who are grabbing strategic chunks of the economy using technology, using smart business processes. And if you join these three pieces together, forensic accounting, capital allocation analysis, and looking at the franchise, looking at the dominance of the franchise in sectors like banking, sectors like consumer discretionary spending, sectors like pharmaceutical, you're able to identify, I would say, 15 to 20 large compounders, companies with market caps around 40, $50 billion, who can grow your wealth at, in say, Australian dollar terms, 16, 17% pretty consistently.